I call upon all nations to do everything they can to stop these terrorist killers. Thank you. Now let's subscribe.
The role of the president in influencing the stock market has long been debated among economists, investors, and scholars. We all know the president doesn't directly control the economy, and they obviously don't control the markets either. But their policies, their political party affiliation, and the way that the public views them can often set the tone for market behavior. In this video, we're going to explore how different presidents impacted the stock market, and we'll do this by analyzing the S&P 500 returns over each one of their terms. One of the most commonly discussed factors is the correlation between a president's political party and the performance of the stock market. Now, I'm not picking a side here, and the numbers don't lie, but there are a couple of underlying reasons why the numbers reflect this way. Democratic administrations have actually tended to see better stock market performance over the past 100 years compared to Republican ones. A study from the Journal of Financial Markets highlights this disparity. It's commonly referred to as the presidential puzzle, and it finds that average monthly returns under Democratic administrations are actually higher compared to their Republican counterparts. Like I said before, there are a few reasons that can explain why this trend occurs, and you can make your own determination on whether or not this data is skewed or if I'm just biased. Republican presidents have often faced some significant economic disruptions during their terms, and these disruptions were arguably black swan events that the president would have no control over. Nixon inherited the Vietnam War, which, let's be real, his policies did prolong, but we're not going to get into any of the details of that. This is not a Vietnam War video. But on top of that, he also faced the 1973 oil crisis, which significantly impacted the market. I mean, look at gas prices back then. They even had to lower the speed limit to 55 miles an hour so everyone can conserve gas. What else? Bush Sr. faced the Gulf War and in a mild recession after the Reagan boom ended in the late 80s. And George W. Bush was a big one. He inherited the dot-com crash, and he ended with the 2008 financial crisis. Both events, especially dot-com, he had very little control over. He also had to deal with the aftermath of 9/11. But on the other side, it was also his decision to invade Iraq and Afghanistan, which turned out to be very costly, pointless money pits. And the taxpayers are still dealing with the long-term economic fallout of those two wars today. And lastly, Donald Trump faced the COVID pandemic during the final year of his term. More on that later. And look, like I said before, I'm not picking sides here. The Democratic administrations faced their fair share of crises too. Jimmy Carter faced really high inflation and super high oil prices that he inherited and really didn't have any control over. His policies were slow and arguably ineffective at dealing with them. Also, Obama faced the aftermath of the 2008 crisis after the Federal Reserve pumped money into the economy for stimulus. Moral of the story is, for one reason or another, Republican presidents have faced more frequent and more severe black swan events. And in many cases, the stock market recovery from these crises occurred under subsequent presidents, which were usually Democratic. And you know what? Their work alongside other policymakers like the Federal Reserve is very effective at getting the economy out of a recession. One can argue that's because Democrats are usually a little bit more prone to expansionary fiscal policy, which stimulates the economy. Some historical examples are Bill Clinton's administration quickly recovering from the early 90s recession, but he also got extremely lucky in the inception of the internet and advancements in computing that occurred during that decade. More on that later. Obama inherited the Great Recession and it was pretty much over by the end of his first term, which means that the stock market had a big rebound. Everyone who bought the recession dip and still holds those assets today made a big fortune. And as for Joe Biden, he oversaw the continuation of the COVID-19 recovery, despite much of the fiscal groundwork being laid out during Trump's presidency. Another important factor in influencing stock market behavior is the perception of the president, the public perception of the president. And by that, I mean their approval ratings. Their approval ratings can often serve as an indicator for political stability. Gotta bring up Jimmy Carter again. Rest in peace, he died at 100 a couple of weeks back. The truth of the matter about him, like him or not, is he went down in history as a bad president. He went down in history as a good person overall, but he was still a bad president. His low approval ratings, along with the high inflation and very slow GDP growth at the time, coincided with a volatile and underperforming stock market. In contrast, the Reagan administration saw quite the rally. And during the periods of economic recovery under his administration, he had very high approval ratings. I'm sure his tax cuts and deregulatory policies also contributed to these high approval ratings as well. The Dow Jones Industrial Index climbed over 140% during his 2 terms. Case in point here is that investor sentiment often splits along party lines. Investors who are politically aligned with the sitting president often have a more optimistic outlook towards the economy. And on the other side of the aisle, those who are opposed to the president may sell out their assets or invest a little bit more conservatively. Political uncertainty, including events like election, a war, or political gridlock, can significantly impact market behavior. As far as election years, we can use a historical example from the Great Depression. When FDR defeated Herbert Hoover, the market was extremely volatile. Investors had no idea whether FDR's policies would be effective in ending the recession. And this is in large part because FDR was one of the first presidents that introduced a proper stimulus to the economy. Before, economists would usually let the markets do its own thing. They wouldn't interfere very much with economic, fiscal, and monetary policy. Once Roosevelt's New Deal programs were enacted, investor confidence surged, and the market experienced sustained growth into World War II. A more recent example would be the 2000 election. Some of my older viewers would remember that there was no clear winner on the day of that election in 2000. There was this whole thing about counting the votes in Georgia, and the Supreme Court had to get involved to determine the outcome. That uncertainty extended a whole month after Election Day until December of 2000, when the Supreme Court finally made the decision. Now, in the Roaring '20s, we had 2 Republican presidents, Warren Harding and Calvin Coolidge. The United States emerged as the new world superpower after the First World War, surpassing Britain as a world power, which held that title since Napoleon's fall. The Roaring '20s were called the Roaring '20s for a reason. It was a booming stock market and the economy was experiencing crazy growth. Calvin Coolidge had very pro-business policies like tax cuts and deregulation. But we all know what happened next. The lack of any government oversight over the financial world created the biggest Wall Street disaster in history. And this crash occurred under Republican President Herbert Hoover in 1929. Much of the gains from the Roaring '20s were erased during the Great Depression. And I think this early part of the Great Depression, before FDR was elected, really shows how important the regulatory and political arm is at stabilizing markets and trying to recover from an economic crisis. So like we mentioned before, FDR imposed a New Deal, and this economic stimulus caused the stock market to gradually recover through the 1930s. Now, World War II started by 1939, and this war effort brought the economy back into full employment. Industrial growth occurred in an unprecedented scale at this time, which created very steady stock market gains. Democratic President Harry Truman saw the continuation of this growth from 1945 up until 1953. There were some short-term corrections, but all in all, it was a period of economic prosperity. The Eisenhower presidency was known for its post-war stability. Republican President Dwight Eisenhower oversaw a country in transition. Consumer spending increased, freeways were built all over the country. This caused families to move into the suburbs. These suburbs were also being developed at this time at a massive scale, and there was significant investment into other infrastructure as well. The Dow Jones doubled again during Eisenhower's 2 terms. Eisenhower's philosophy was to keep government spending low, which in turn kept inflation low. And this created quite the optimistic sentiment in the market, causing the stock market to thrive. Economic growth and stock market gains continued into the 1960s. Kennedy introduced tax cuts, and under Johnson, the economy continued to expand. But Johnson also brought us into the Vietnam War, and all of a sudden there were a lot of inflationary concerns by the end of the 1960s. And this set the stage for the 1970s, which was quite the challenging decade. Nixon inherited the Vietnam War when he started his presidency in 1969. He had to deal with the 1973 oil embargo, and then the cherry on the top was the Watergate scandal, which fueled a lot of political instability and shattered investor confidence.
The Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a 0.5 percentage point. A broad set of indicators suggests that conditions in the labor market are now less.
Jimmy Carter came in 1977 and just had to deal with the economic crisis that his country was facing. And he didn't do a very good job at recovering from it. Late 70s was a period of dismal returns and very high volatility. The Reagan boom. The Reagan boom marked a significant turnaround in the US stock market. He was big on supply-side economic policies. He He brought tax cuts, he brought deregulation, and he increased government spending through the defense budget. And well, the Dow Jones more than doubled during these 2 terms. The market was really heating up and things were starting to get a little bit overpriced. This huge period of economic growth cannot be sustained forever. It's like the economy is on drugs. He's gonna have to come down at a certain point. And that's what it did. 1987 saw Black Monday, where the Dow Jones fell by more than 22% in a single day. A 1990s economy. During Bill Clinton's 2 terms, the S&P 500 more than tripled. And look, I'm not saying this is all attributed to his policies. The 1990s saw the inception of the internet and significant advancements in computing. But as far as his policies, he was very careful with the budget, and the government actually had a period of budget surplus. Compare that to today, where the debt ceiling just rises and rises. We live in an economy today where it's a debt economy. We just operate the economy by increasing our debt, and that's how we sustain a larger margin of growth. Clinton achieved this by increasing taxes on the country's highest earners and cutting government spending. So there was this combination of rapid technological advancements, increased economic globalization, and also increased political confidence, which just all culminated into a cocktail of optimism. Something interesting that happened during this decade was a new normal for the natural rate of unemployment. But it's not just because people woke up and just wanted to work harder all of a sudden. It's because of the internet. The internet made the job search process so much faster. People didn't have to go to these employment offices. They didn't have to send their resumes and letters. They can just look at job postings online and submit their resumes online, and there was no need to drive back and forth to a place or send your resume over snail mail. Job postings were updated online, and you didn't have to rely on job postings in a newspaper, which had to wait until the next printout to be updated. But light is always followed by darkness, and the speculative nature of this internet boom started to show a lot of signs of volatility by the end of the decade, and it eventually burst in the year 2000. And that leads us into George W. Bush. George W. Bush inherited an economy that was recovering from the bursting of the dot-com bubble in March of 2000. This tech-driven stock market was declining well into 2002. Things started booming again, but this time it wasn't in tech stocks, it was in real estate. By 2008, we all know the financial system collapsed. Now, you can make arguments of whether or not this was his fault or whether this was something that could have been prevented, but considering the amount of people running the economy at this time, I don't think George W. Bush was thinking about mortgage-backed securities and credit default swaps, especially with 2 wars on his plate. Over his 2 terms, the S&P 500 fell by nearly 40%, making the Bush presidency one of the weakest for the market. In response to the 2008 financial crisis, the Bush administration, along with the Federal Reserve, introduced a massive stimulus to the economy. Much of this money went into bailing out the banks. I always thought this was interesting because this did go against his limited government oversight and limited spending mantra that he was going on for this whole presidency, but it's simply what the economy needed in order to survive. Obama took over in 2009, and we were in the midst of the Great Recession. Goes without saying, the stock market and the economy were facing its biggest challenges that it's ever faced since the Great Depression 70 years prior. A lot of the groundwork for the economic recovery was already laid out by the Federal Reserve and the Bush administration in the final years of the Bush presidency, but Obama and other policymakers did quite a good job at continuing this economic recovery, which resulted in the S&P increasing by about 150% during Obama's 2 terms. There was a lot of political polarization, but overall the country was pretty confident in Obama's ability to recover from the Great Recession. And this helped fuel the prolonged bull market. There were also policies introduced to restore confidence in the country's financial system. One example of this is the Dodd-Frank Act. These pieces of legislation regulated financial institutions. Now we're going into the 45th and soon to be 47th president of the United States of America. This president was known for very strong economic performance. In the 3 years from the time that he was inaugurated up until COVID hit, the Dow Jones increased by 56%. This was all driven by corporate tax cuts, deregulation, especially when it came to the environment, and also a focus on American business. This was brought about by the 2017 Tax Cuts and Jobs Act. There was a little bit of uncertainty with Trump's trade wars, but overall, investor confidence was very strong. COVID-19 came in 2020 and wiped the stock market clean of gains from years before, but the massive economic stimulus that was introduced under Trump and the Federal Reserve, way surpassing that of 2008 for that matter, did a stellar job at recovering the economy, and by the end of 2020, just several months after COVID first hit, the stock market was already at new all-time highs. Now we're going into Joe Biden, who, at the time of the making of this video, will continue to be the sitting president for at least the next couple of weeks. Joe Biden's presidency began during a period of recovery from the COVID pandemic, and the stock market reacted very positively to his stimulus measures. 2021 was a great year for the stock market. We were all making money, whether you're in crypto or NFTs or stocks, and everything was going crazy. It was awesome. But 2022 was a little bit ugly. Federal Reserve finally increased interest rates, the Russia-Ukraine war started, and inflation started being an actual concern. There was a bit of a downturn. Now, obviously, 2023 and 2024 saw a pretty good recovery from this 2022 bear market. So it seems like we overcome a lot of these challenges. Inflation's come down, interest rates are still up, but the market has remained pretty resilient. So while the president undeniably influences the stock market, attributing stock market performance to whoever the president is just really oversimplifies a complex system. Factors like global economic and political conditions, Federal Reserve policies, and also technological innovations. These are all factors that highly affect stock market performance. And the stock market is not always a reflection of the broader economy. It's really a reflection of investor sentiments. And those that are benefiting from stock market gains are usually high income earners and corporations. So it really doesn't reflect on the performance of the average person. The effects of the US president on the stock market can offer some information for policymakers, investors, and scholars. For politicians and policymakers, they can't get too radical with their initiatives because policies that are determined as too radical may be a detriment to investor sentiment. But radical policy, if implemented properly, can be beneficial for the economy long term, and for investors recognizing the connection between political cycles and market trends can be informative for one's investment strategy, especially during election years. But you might as well not worry about trying to time the market. Just stay in the market for the long term, whether you're in index funds or you're investing into strong, fairly valued companies. And for scholars and traders, research into the intersection of politics and market behavior can show how non-economic factors shape financial systems. To wrap this up, the influence of the sitting US president on the stock markets is influenced by policy decisions, political party affiliation, public perception, and broader economic and geopolitical conditions. And historical comparisons show that while presidents can influence market sentiment, external factors like economic cycles and global events far outweigh the effects of any policy action that can be enacted in the executive branch. Thanks for watching, guys. This is Corp Dorks, and if you want to watch any more videos on economics, finance, history, geography, go ahead and hit subscribe. I'm going to be trying to have new videos every couple of weeks. Fight on, and I'll see you in the next video.